Hi, you're listening to Avenue Insights. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based on information available at the time and are subject to change without notice.
So I thought for today's conversation, it would be interesting to shift gears a bit because there's been so much news and focus on the equity markets and the volatility that has been there for the last several months. And so I thought it would be interesting to turn our view on the bond market and talk about some of the dislocations that we've seen on the credit side and really, the depths of March, maybe speak to what you were seeing in terms of corporate credit and both on the government and
Well, we have to always kind of reiterate that the bond market is 10 times the size, if not more, of the equity market. So it tends to be the big dog in the financial markets because it 9 times out of 10, it influences the equity market. And so the essence, and that was the problem in March, we had a bond market that stopped working. Right. And inherently, not only do you have to deal with the virus and everything around it, but the last thing you wanted to deal was the illiquidity coming from the bond market. And we saw the Federal Reserve and, for that matter, the Bank of Canada go all in and try to stem the tide and try to increase liquidity at the highest level. They have never done stuff that we have ever seen in the history of financial markets. Yeah. Basically going all in and just buying anything in sight to stabilize it. And they were going up the risk curve in the high yield market where, yes, they're not the Federal Reserve. So first of all, let me explain that the Bank of Canada announced it last week, but they're not, other than buying Government of Canada's, they're not buying provincial debt or corporate debt until May. So we don't know we're just still trying to find out what that means. We know that there's 50 billion of purchase in the provincial market and about 25 billion in the corporate market. But once again, we don't know what that means. But in the Federal Reserve, they've actually gone in and bought extensively all maturities, a lot of the risk curve, and municipals. And that inherently was to at least one arm of the financial market is all about liquidity. And if you don't have liquidity, one of the legs of a stool falls out. So at least they have that in place. And it's more or less been working, even though it has been, the bond market has not functioned properly. And it's still, to this day, is still kind of, it's not in a great space just because it's still price discovery. You're still not getting, when you go out to purchase or even when you go out to sell, it's still, though the spreads are very wide and it's very hard to transact. Right. And really, the only thing that's transacting well is actually when companies or provincials come out and issue debt. Right. So because they have to make a market on the debt. Yeah. They have to. That's almost the benchmark for the current market. So, for instance, the last 2 weeks we had Rogers and we had Bell come out. And these things were usually 80 to 100 over. They did the deal at 300 over. Right. Oh, sorry, I'll kind of explain to so when I say 300 over, it basically means how corporate spreads are, or how corporate bonds are priced off of Government of Canada bonds, but you embed a risk. And of course, that's a risk premium or a spread premium. So if, for instance, for simple math, if Government of Canada's were trading at 1% yield, your Bell Canada bonds, if they issued 10-year bonds, they had to issue at 300 over. So what's that mean? 300 basis points over 1%, which is effectively they had to issue at 4%. Yeah. And they both issued extensively and quite well, and the market was overbought. So there are buyers in the market. It's very hard to transact when you have these wide spreads.
The other interesting thing, and really it's been in the last couple of weeks as the market has opened up again, and to your point, there's been new issuance, but I think it was the Rogers bond. Was it 20 times oversubscribed?
Yeah, 20 times oversubscribed.
It just tells you how much money there is on the bond market on the sidelines trying to buy assets. But in this price discovery world where there's still a pretty big spread between the bid and the ask size, that there's still that price discovery happening.
It is. The secondary isn't really working. So that's why you're getting all these. Generally, in deep into the bond market, there's more buyers than sellers. Because if you got a tap on your shoulder saying you got to sell those bonds because we have to raise money, it was already done in late February, March, and finished off. So you already had that. Now the spreads have not moved out more. They're actually stabilized and actually come in quite a bit. So relative to where we were, we're actually in much better shape than from a week ago.
Right.
So that's...
You mean in terms of bond market liquidity?
Right.
Yeah.
And also spreads have come in.
Yeah.
And it's a successful issuing of all this debt, and there's more debt to come.
Yeah.
But it's almost like if you have excess cash, you can't even bother the secondary market. You actually have to go and buy the new issues, and that's why there's so much pent up demand for this. Like Suncor bonds, we had just recently bought. Crazy. It was at the kind of the worst time for credit markets, but best time to be a buyer.
Yeah.
And we bought Suncor bonds at 5% for a 10-year.
Yeah.
And that is now, of course, when I say Suncor, everyone's going to kind of think, well, that's in the oil industry and there's under stress. But Suncor has a pristine balance sheet and will handle the depressed oil prices and actually see right through it once we find
they have the ability to get through this.
Yeah, and plus they have midstream operations, and plus
refining assets,
refining. So it's not just an oil producer;
right.
It's a conglomerate. But anyway, the fact is just to give you a proxy, is at the worst we got it at 400 over effectively, and now I'll even make it even simpler. We bought the bonds at par, which is 100, and they're now trading at 106. Wow. So they've gone up 6%. Just the bonds itself, the spreads, and the yield has dropped down considerably, down to about 4.2%. It used to be at 5. So that gives you a good perspective of what's happening in the Canadian market.
Yeah.
And it's nothing dissimilar to the U.S. market. And then of course high yield is even, higher yields and more volatility, but they've also come in as well.
Have you seen any new issues that you in what you'd consider the high yield market? Is there anything that's been priced recently?
Well, no. They're not. You know what? The high yield sector is still there. Absolutely cannot come out with a new issue.
Right.
But there was some secondary pricing, like we know of Parkland.
A couple.
Parkland Fuel.
Right.
Came out, and that was 7% yield, and we actually participated in that. That was secondary. It was one of the lucky ones that we found some liquidity, and we immediately bought it, and now it's trading about $3 higher. So that's about a 3%, 4%.
But I guess it was kind of a simple answer to that question, but I can't imagine a high yield company issuing in this kind of environment.
No.
The market's closed.
No, basically, unless you're really in a deep market, like maybe in the U.S. there's some, but it's impossible, and you wouldn't want a maturity right now, so you have to reissue your debt.
The other thing, so just going back to, we've talked about this for years in either client presentations or at the cocktail party or in quarterly reports, is the idea of when you took the corporate bond market and you packaged it into ETF products, eventually you were going to get to this point where there was some kind of an event in the financial markets, and the corporate bond market isn't meant to be traded every second of every day in the ETF world. So maybe talk to that little
that's a good point.
Angle effect, but just say, how big of an impact do you think the ETF world on the bond side had on a lot of that illiquidity?
So taking a step back, the ETF market was created just to get a passive index strategy, and it makes a lot of sense in the equity markets or in the the large caps, the dividend payers, or even the MCSI,
international,
It's a way of retail investors, used to be also only institutional investors, but it was a way that retail investors could get access and have a lower cost. And the regulators loved it because, fees were down by half, if not even more. And it was the right product for the times. The trouble is, it's like a small doorway where everyone's getting out of the exits, where you have 10 times the size of an ETF market with the underlying being corporate credit, being 1/10 that size. And inherently, when someone hits the sell button and everyone wants to sell at the same time, there's a massive gap difference, a valuation difference, a net asset value difference, whatever you want to call it, between the underlying securities that they're underpinning or they're replicating and the real market and the ETF market, which is priced differently, to the point where there was a substantial discount. I can't remember. I think
it blew
it was
one day,
what, 10-12%.
So it blew out 5 or 6% on the downside,
right?
And the next day it was up 5 or 6% on the upside. So it was
an
absolute
like good
10%
to 10
spread.
to 12%
Yeah.
out, and so you're selling your ETF at a 12% discount to the underlying
Bonds,
securities,
assets, yeah.
and the reason is because the market doesn't function when the market isn't functioning. It's very hard to get a bid because it's not a centralized market, right? Still, the bond market is based on trader desk and on prop desk. It's still a large institutional bank product in the sense that you're not there to look to exchange bonds at a reasonable and flexible way. When there's a stress situation, it's not like the stock market where by law almost you always have to show a bid offer. In the bank world, in the bond world, when there's a moment of liquidity strike, the banks say no bid. So you can't sell, and so they'll just do agency, and we saw that over the last 6 weeks, where they would just, if you need to sell something, and thankfully we didn't really need to sell anything, you couldn't sell. You'd had to plead with them to take the order, and then maybe they would try to find someone, but then inherently they would fail. So when you have this sell on the ETF side, they have to settle.
You're selling into the abyss, but someone has to.
And there is synthetic product inside the banks that replicate the corporate credit structure, but even then that has limitations. So what we've always been saying is that ETFs, it's a nice strategy, but there's risk inherent to it, and there's liquidity risk, and we just saw that happen, and it's pretty scary because everyone keeps driving the ETF market, but the underlying is not stable.
Yeah, I think the interesting thing is seeing how, in sort of on the bond side, the ETF world became a product making machine. And so you'd have a corporate bond ETF, you have high yield, then you have a bank loan ETF, then you have an emerging market debt ETF, which is, you're going down layers of illiquidity.
Right.
And so you created a product set that the banking industry was able to, market for a decade in a really good environment, and everything's kind of okay. But you eventually hit that wall where all of a sudden the liquidity is an issue. But the other thing too is, do you think that a lot of the regulation that the banks had out of 2008, 2009, where the big trading desks at the banks used to be able to inventory bonds.
That's a great point.
It's kind of like, it's like driving a car without having shock absorbers on it. And it almost that like even magnified things even more, I think.
Yeah, I mean, you're going back even, when I started in the late 80s, there was the great bond traders of the world, and they had Lehman, and they had desks that were dedicated and had leverage to it, but were market makers. They were the price makers, and that's how the bond market functioned in stress situations. But because of Dodd-Frank's, you took the capital away from those desks, those prop desks, and they weren't allowed to make aggressive market pricing, or maybe they were, but not at a leverage situation.
Right,
you had to put it this way: you had to hold capital.
Right.
The problem is you had to hold capital against,
costlier.
Which is costlier. Which most of the senior bank guys would say, forget it. The margins you make is so little. I'm not giving you capital to expand this desk. But back in the day, before those laws, you could leverage, and that was the problem in 08, 09. I don't know if it's the same apples to apples, but when Lehman was 40 times leverage, that's a huge problem. But they force you to basically go down to nothing, where 10 times leverage is probably not a bad thing.
Right, and but the lack of the shock absorbers on the bank trading desks kind of, you'll go a number of years without it mattering, and then all of a sudden there's just no liquidity.
Yeah,
and there's a couple of those days we saw it was very clearly that bank products and other products were getting liquidated, and there's just no one there on the other side in that kind of an environment. No,
it's very frustrating. Like for 2 years inside here, I kept saying, I don't want to own high yield, and other than some specific, I think the sector is so overvalued. And I sat there this is the thing, being very patient as a bond manager, is that you the day's coming, because these days come once every 4 or 5 years, but you're sitting there 2 years into it saying, it's just never happening. But unlike the stock market, where there's such a pressure point or pinch point that you have to give up your strategy, in the bond market it doesn't hurt as much, because you're just missing some small returns from spreads that you should be invested in, but you don't want to be.
Right, like those,
so it's not really a big sacrifice.
It's not like you're missing out. Huge.
Yeah. So back in the day, if high yield, not back in the day, literally 2 months ago, high yield was at 5% yield, and that was considered high yield. Yeah. Well, I in my world thinks, I know rates are down, so you have to take that into consideration, but it should be at least 4 to 700 over, 4 to 7 percentage points over, and you should be earning in this environment at least 6 to 10 in high yield, and you were getting 300 over, and right now investment grade bonds are trading at 300 or 3% over government Canada. So it's gotten extreme. So we benefited, and that's why we just made our first purchases strategically of our portfolios on the bond side just the last 2 weeks, and that was really the first exciting purchase I made in the bond market in the last 2 years in a way.
Yeah, it's interesting too, watching how through the end of March and having a significant amount of cash in the bond portfolio is one thing, but then there's still the ability or trying to go and transact when there's basically no market to transact into, where there was that 2 week period where I would watch you every day and it would be, I'm trying to buy something.
It's crazy.
And there's just no one, because people that are trying to sell to you at the prices from 2 months ago. And the people that are trying to buy, they don't need to buy.
No.
There's no urgency to buy.
Yeah.
So there was this huge spread where it took 2 weeks to get.
Yeah, it was like a moment in time that the door opened up, and then we quickly got in, and then it closed in a sense. That's the problem when you want to do it yourself as a retail investor. So it made sense to do the ETF. You certainly can't buy individual bonds. That's too hard. So the derivative of that is, of course, owning ETFs. But the warning on the label was warning this could the spread between the underlying and the fund that you own could separate, and it did. Now that being said, it'll probably fix itself, because like bonds, unlike stocks, bonds have a maturity date. So the spread will eventually narrow, but it doesn't feel good. Or you could hire kind of guys like us that actually look at the credit markets and have the ability to make strategic decisions on these type of credits and to avoid it.
It's tougher. I mean, the one thing, in the U.S. after 08 or 09, they took rates to zero. Rates in Europe were zero. Rates in Europe are now negative. They're negative in Japan. And now the Bank of Canada has basically gone to zero, or 25 basis points on the overnight. But we're now actually in the last 2-3 weeks, the Bank of Canada launched a quantitative easing program, which is, government.
And this is the first ever.
Central bank sort of being in the market. Mm-hmm. But I think, I guess I would say, for someone who's been in the bond market for 30 years, did you ever think that, did you have any idea what quantitative easing was 30 years ago? And did you ever think the Bank of Canada would be here?
We did from Japan, right. Japan's experience. I remember sitting there in 96, 97, listening to an economist, and they were only 5 years into a 20-year recession, and they had pushed rates down to close to zero. So we did know the essence of it. And the problem was, of course, with Japan is that it's in such a deflationary spiral just because of the demographics and because of other kind of things. So we did see it, but we never thought it would. Well, actually, I take that back. It was like a bad. It was like a disease that was spreading. Excuse the current virus issue, but it started in Japan, and then it washed it on the shores of Europe 15 years later, and now it's washed onto the shores of North America, and the whole world is going zero. And that's the new 2%, or new 4%.
And to have the central banks of all these big countries acting in the bond market, where I think the Japanese central bank owns 100% of their bond market, almost, give or take.
Yes.
In Europe, it's getting close to 40%. I think the U.S. is still 20%, but increasing rapidly. And it's, I just, how we get out of here, I think is the magic question.
Yeah, I would love to say I know. We don't know. None of us knows. Yeah. But you're at least on paper, you're creating such a massive inflationary moment here.
Potential.
Not now. Absolutely not now, but a year from now, when we get the vaccine and everything settles down, what does that mean? Because the system is hooked on loose credit and lower rates. You're going to eventually have to take that away. At the same time, you're fighting massive budget deficits. So we don't know how this plays out. It's not like an Argentinian situation where, like, the currency goes to zero, because the reserve currency more or less is the U.S. And by proxy, by derivative, it's Canada is the second, because we follow them. But I just don't know how this plays out. I mean, let me make this perfectly clear: the U.S. specifically and Canada secondarily want inflation back desperately, because that's the only way they can get out of their deficits in the U.S. We're riding let's say this year will be a $4 trillion deficit. And with a depression in the GDP, you're talking they're adding probably between 20 and 25 percentage points on debt to GDP, which is historically never happened ever.
Yeah.
Like in 2008, it was 8%. No, what was it, 9%?
It got up to 10 or 11, yeah.
So this has never happened. Yeah. And then let's talk about 2021. You're going to get some reverberations from 20. So we won't be there, but let's say it all works out. We're still going to be in the U.S. Probably a $2 trillion deficit. So it's probably going to be with some growth in the economy. So you're probably talking at least 7 to 10.
7 to 10, yeah.
That's crazy. And I don't know, when's the last buyer buying? Yeah. Because then that's the time that the game is over.
I guess the difference is, and like looking at Argentina also, where they got in trouble is because the domestic economy had collapsed, but they had a huge part of their debt in U.S. dollars. So there was the currency mismatch where basically they were short dollars, where if the U.S. government or the central bank is the biggest buyer of their bonds, or if the Bank of Canada is the biggest buyer of provincial bonds or federal bonds, there's this, you can kind of keep it going for longer, right? Because for everyone that is just in the domestic economy, you kind of go about your day and you don't really realize what's happening. Yeah. It's just in these extreme scenarios where you borrow in a different currency that you get caught offside.
Yeah, we were talking about it today, and maybe you could talk a little bit about what could happen. It's like you mentioned that, with printing money or quantitative easing, the difference here is you're filling the bucket.
Yes.
You're not creating, like in a recession or depression, you're throwing money out for people to spend.
Yeah.
But the trouble is their debt, everyone's debt is so high that you're just trying to
fill the bucket.
And I don't know.
Yeah, like
you can talk a little bit about that.
Idea being just there's so much leverage in the economy, both at government level, corporate level, and for that matter, individuals, that you've had such a shock to the system where, people aren't working, your economy's not growing, people aren't having incomes. And so a lot of the money that's being created by the government or the central bank and printed electronically, it's just filling in that lost income. So in the US, the package from the government was about $2 trillion. That's just filling in what was lost in this next 6-month period. Or same thing in Canada, where you can print money to fill the bucket, but I think the problem coming out of this is just going to be politically, where does all of this go? And, how is the government coming in now and picking winners and losers? What does tax policy look like going forward?
It's all unknowns. You said, it is to fill the bucket, and it's here. Let's even bring it down to the easiest level. Is like someone's has a debt of $1,000, and basically the government's giving money to lower that deficit to say maybe $800 to $200. It's not going to change the behavior that much of the individual, whereas inflation is based on kind of also psychology too. When you embed in your decision making, everyone negotiates every day. And when you, back in the day in the 70s, you would negotiate, especially unions, they would negotiate price escalations for their wage and salary because they know the monetary base is inflating. So it takes a long time for that to kind of push through where there's wage, and then of course it's a virtuous cycle, or a vicious cycle, I should say. It compounds on itself. You get more money, then the money supply increases, more activity, then there's more inflation. But the trouble in this society where goods are almost free, I don't mean that.
I mean inflation in goods.
No, it's like there's too much capacity. Yeah. Give me some sector that we just found out that oil's not inflationary.
Yeah, the oil contract today was minus $40.
It went to minus 40.
It shows you how we're in such this structurally deflationary world.
Right. So what does that mean when you go inflation? Does it neutralize it? Does it reverse itself and wickedly adds inflation? We certainly want, as a whole, as a society, if you could tell me I could get you to, in 2-3 years, 3% inflation rate and it hovers around 3, that would be really good. Because then over time, your debt will depreciate against the inflation and the economy will get revving up. But I don't know, because if I was in deficit and the government gave me money, you're just either paying bills or you're just trying to stay afloat. We know this, all over the place.
Or pay your bills or
So,
mortgage.
but that doesn't say I'm going to go out and spend on a TV or a car
or go on a trip.
It's going to help, but it's not going to really change society. So I don't know if inflation even flows through that. So does that mean that you can print money endlessly and it just keeps? I don't even know I can't even ask that question.
I think the problem I think is that where it comes back politically is that you can keep printing money, you may or may not create inflation, but where you certainly will create inflation is in assets.
Yeah.
So the wealth divide gets worse because people that own assets, their assets will go up in value. So there's this, this societal gap that is there keeps getting worse.
Yes.
And that's over the next several years, how that gets resolved, I think, is the magic question.
Right, and that would probably mean, unless you have civil unrest, you might have to adjust tax rates where the wealthy really pay. Now, in Canada, we have a progressive tax rate, so that's not as much an issue, and our gap isn't as high. But we're really specifically talking in the U.S. is that, I'm so curious when they see through this all, whether you have a Democratic president or a Republican president. Someone's gonna have to raise tax rates.
Yeah, how are we paying?
But it's a taboo to even mention. They can't even say entitlement reform. Yeah. The Americans can't even say that. They can't even come close to saying raising taxes.
Sacrosanct.
It's heresy.
Yeah.
So I think you're gonna have to do it.
But I think where the stuff that we studied here and thought about is that when governments get into these scenarios where they have basically uncontrollable levels of debt, the most politically palpable way to do it is to create inflation. Yeah. And because then, everything kind of gets slowly inflated away.
For sure.
And it creates the least unrest.
Yes.
From people. And there's going to be people that, are upset.
The problem is, in the end, the middle class gets hit again because the wealthy guy, his asset prices are really through the roof. His cost of living is actually slightly higher, but no difference relative to what his just running his day-to-day life.
Yeah.
It's the middle class that gets hurt. But I still don't know. You're gonna have to tell me, how does inflation creep up?
Yeah. No, I don't think for the time being, you don't see it in the real economy. You can see the scenario where there's asset inflation, with all this money
and
printing.
Now we've seen gold also.
If you look at the price of gold, and even the fact that stocks are at this level, with how weak the fundamentals are, a lot of this is built up on what the Fed is doing and all the central banks printing all this money.
Both of them are manipulating the stock market. It seems like the only policy or the only thing they can try to control is the stock market. They can control the bond market, but of course they own the bond market because they set interest rates. But they never own the equity market, but they're trying to make it, it's kind of the worst way of doing it, by making interest rates so cheap. Relative to interest rates, your equity market is so much better, but the trouble is your operating earnings that are going to come out in 2020 is going to be terrible. And even the analysts who even drag it down, then tell me how this plays out. Yeah. I don't know how this plays out in 22. There's so many unknowns here. I can't even intellectually come up. Usually we all come up with plans that you think, whether they're right or not, you at least have a theory about it. It's so hard to even put the pieces together.
The variance of the scenarios are so huge. Yeah. Where we used to live, the whole world lived in such a tighter band, where now we're in this kind of alligator jaws of scenarios. And it's trying to think about all the different things that could happen is, obviously fascinating.
Yeah.
So why don't we wrap it up there and we'll look forward to the next time we chat.
Yeah, that was great. Thank
you.
Okay,
awesome.
Okay.
I hope you enjoyed today's conversation. You can find us on avenueinvestment.com, where you can learn more about the topics discussed today at our blog or subscribe for updates to our content. You can also follow us on YouTube, Apple, Spotify, Google, or wherever you get your podcasts. Thanks for listening, and we'll see you in the next episode.